Today, we are tackling one of the biggest questions in all of finance. Is the stock market just a totally random, unpredictable journey, or is there some kind of hidden code, a pattern, that smart investors can actually use to get an edge? It's a debate that splits Wall Street right down the middle, and we're going to dig into both sides. Right, let's get into it. You've got this one idea that says you might as well throw a dart at a stock list to pick a winner. But then, on the other hand, you have these legendary investors who seem to have a system, right? So, which one is it? Well, we're going to follow the data and see exactly where it leads us. So, first up, we're going to look at the very powerful and, honestly, very convincing argument that the market is almost entirely random. This is the view that really dominates academic finance, and you're about to see why. Okay, so the core of this idea is something called the efficient market hypothesis, or EMH. It basically says that at any given moment, a stock's price has already absorbed everything people know about it. All the news, the earnings reports, the big economic forecasts, all of it. So the only thing that can possibly change the price is new, totally unpredictable information. But how do you even test a theory like that? It sounds impossible. Well, researchers came up with a really clever method using information theory. Think of it like this. Imagine running a stock chart through a special kind of filter. This filter is designed to separate the predictable patterns, which we'll call information, from all the random, meaningless static, or noise. All right, let's look at what that filter found. This chart right here is for the CAC 40, a major French stock index. You see that black line? That's the amount of predictable information the test discovered. And the gray lines, that's the threshold where the information actually becomes statistically meaningful. Now look closely. Notice how that black line almost never crosses into that zone. That's the data, plain and simple, telling us that most of the time, the market's movements are just random noise. Okay, let's hop over to the US and look at the Russell 2000, which is an index of smaller companies. And yep, it's the exact same story. That black line is barely getting off the floor. It's almost pure noise with very, very little predictable signal to be found. So you might be thinking, okay, but what about a single company? Maybe the big indexes just average everything out. Good question. This chart shows the stock for a company called Proficient. And you know what? While you see a few more spikes, the story is pretty much the same. Just these brief, fleeting moments of potential predictability that quickly vanish back into the randomness. Now, to really put this theory to the test, let's look at one of the wildest, most volatile markets on the planet, Bitcoin. Even here, in a place where you think patterns would be everywhere, this study found that over 95% of the time, its price movements are statistically random. I mean, based on these charts, the case for randomness looks incredibly strong. So the data seems to be screaming that it's all random. Case closed, right? Well, not quite. Because if the market is really that perfect and efficient, it has a really hard time explaining some pretty big real-world events. Exactly. If everything is always priced perfectly, how on earth do you explain something like the dot-com bubble, or the 2008 financial crisis, or even just legendary investors who seem to win year after year? Those moments feel anything but rational, and they open the door to a completely different way of thinking. And this is where behavioral finance comes into the picture. It argues that, hey, markets aren't run by perfectly rational computers. They're run by us, by humans. And we have all these psychological biases, things like fear, greed, overconfidence. The theory says these emotions actually create predictable patterns and little cracks in the market's efficiency that a savvy investor could potentially take advantage of. Now, investors who are looking for these patterns usually fall into one of two camps. Over here on the left, you've got fundamental analysis. You can think of these folks as the detectives, digging through company reports and economic data to figure out what a company is really worth. Then on the right, you have technical analysis. They're the chart watchers, the ones who believe that all the clues about investor psychology are right there in the price and volume data on the screen. So if these behavioral patterns really do exist, how do you invest in them systematically without just guessing? Well, that question has led to a much more modern strategy, one that tries to capture these patterns in a really disciplined way. It's called factor investing, and the idea is actually pretty simple. Instead of trying to pick individual stocks, you build a portfolio that intentionally leans into specific, measurable traits or factors that have historically paid off. This could mean tilting your portfolio towards cheaper, value stocks, or maybe stocks that are already on an upward trend, which is a factor known as momentum. And listen, this isn't some new fad. This has a deep history in academic research. It all started back in the 60s with a simple model that said only market risk mattered. But then in 1992, researchers Fama and French had this landmark paper showing that two other factors, the size of a company and its value, were also super important for explaining returns. And from there, the models have just gotten more and more sophisticated. Okay, so why does this whole academic deep dive into financial theory actually matter to you? I mean, what does it mean for your portfolio? Well, it matters because this stuff is no longer just for professors and high-powered hedge funds. It's crucial because these incredibly complex strategies are now accessible to absolutely everyone. They're packaged up into things like exchange-traded funds, or ETFs, which you can buy and sell in your own account just as easily as you would a single stock. Let's peek inside a real-world example. This is the Schwab US Large Cap Growth ETF, ticker SCHG. It's a factor ETF specifically designed to capture the growth factor. It does that by investing in large companies that are expected to grow way faster than the overall market. And when you look at its top holdings, yeah, it's a who's who of the biggest names in tech. You recognize all of them. So, the big question, does this factor-based approach actually work in the real world? Well, just look at the performance. This table shows that since late 2011, SCHG has delivered an annualized return of nearly 17% per year. That really shows you the power of systematically betting on a specific pattern, in this case, that growth factor. Now, it's not the absolute top performer on this specific chart, but it clearly demonstrates a really strong, consistent return based on its chosen factor strategy. And this quote just brings us right back to the central conflict, doesn't it? On the one hand, you have the pure math from information theory that says markets should be random. But on the other hand, you have the success of strategies based on these behavioral patterns, like the one we just looked at, that suggest human psychology creates opportunities that totally challenge that randomness. So what we're left with is this fascinating paradox. The cold, hard math shows us a market that is overwhelmingly random. That's the wisdom of the crowd. And yet, strategies built on exploiting predictable human behavior have at times delivered absolutely incredible results. So the final question is really for you. After seeing the data, do you believe in the random walk, or are you going to search for the patterns in the noise? There is no single right answer here, but understanding both sides of this coin is the absolute key to building an investing philosophy that really works for you.